Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice.
My name is Stuart Watson, and I am standing in again for Jonathan to cover this week's market roundup. Jonathan has recorded an interview with Denis and Laura Foll of Law Debenture, one of the best performing UK equity income trusts in recent years. That discussion will be coming up shortly. Interest rates were the main focus of attention this week for markets. The Fed left US rates unchanged, but hinted strongly that it would look to cut rates next month. The Bank of England cut rates by 0.25 percentage point to 5% in its first meeting since the general election. The Bank of Japan raised its rate from 0.1% to 0.25%, and that's the highest Japanese rates have been since around 2008. This saw the yen strengthen against most major currencies. 10-year government bond yields in both the US and the UK dipped below 4% for the first time since the start of the year. The new Chancellor, Rachel Reeves, said that the Labour government's first budget would be held on the 30th of October. It looks like it will contain a number of tax rises due to a £22 billion hole in public finances, caused by a combination of recent spending commitments and unexpected expenditure. This, however, is something that many commentators were warning about before the election took place. UK shares were flat for the week as of Friday morning when I'm taping this, and US shares were also broadly unchanged after the first 4 days of trading. That does, however, mask a lot of volatility. We saw a 2% gain in US markets on Wednesday, and that was reversed on Thursday following weak US economic data. The close-end index was up around 1.5% from Monday through to Thursday, but looks set to fall on Friday. Turning now to trusts reporting their results in the past week. CT Managed Portfolio, run by Peter Hewitt, published its numbers for the year to the 31st of May. Its income shares returned 7%, while its growth shares returned 12.7%. However, both share classes lagged the 15.4% produced by the FTSE All-Share. Pantheon International, the veteran private equity trust, recorded a 6.1% NAV gain, and that was for the year to the 31st of May. Valuation gains added 5% and share buybacks a further 4.7%. These were offset by currency effects and other expenses. Henderson Smaller Companies posted a 14.5% gain. That was to the 31st of May again, and that was a little behind the 18.2% produced by its small cap benchmark. It was very much a year of two halves, though, with an 8% loss in the first 6 months of the year and then a 24% gain in the second. We also had half-year reports to the 30th of June from a number of popular trusts. Smithson had another difficult period. Its NAV fell 1.8% over the first half of 2024, while its global small cap benchmark returned a positive 3.4%. RIT Capital Partners reported a 4.2% return for the first half. That was well behind its global benchmark's 12.9%, but just ahead of its inflation plus 3% target. This was the first report we've had under the new investment team that's led by Maggie Fenari and Jonathan Koo. Scottish American, the global equity income trust that's run by Baillie Gifford, that was another to lag its benchmark in the first half. It returned 5.5% versus 12.2% for its comparator index. F&C, though, did beat its benchmark. It returned 13.2%, and that was against 12% for the FTSE All-World Index. We heard about another merger this week, and that will be between JP Morgan Japanese and JP Morgan Japan Small Cap Growth and Income. That's one of many mergers between stablemates we've seen over the past year. As the larger trust of the two, JP Morgan Japanese will be the continuing vehicle, and it should end up with about £1 billion in net assets. JP Morgan Japan Small Cap shareholders are being offered a cash exit, and that's for up to 25% of their shares at a 2% discount to NAV. Fees for the enlarged trust are also being lowered, and the deal should complete around the end of October. We had various second quarter NAV updates, the most notable probably being from Chrysalis, which has materially written down its position in WeFox. Chrysalis invested €5.5 million in WeFox earlier in the year and put in a further €15 million in July to help shore up the business. But it said that it's not expecting to make any further investments in the company. Biopharma Credit said that Roche has now completed its takeover of Lumira DX, which has been a troublesome position for the trust in recent months. Biopharma reckons that, including interest, it should receive 96% of the $206 million that it lent to Lumira in total. Biopharma also announced a new loan investment for $130 million and said that it was launching a discretionary share buyback program. Pershing Square Capital Management, the manager of Bill Ackman's Pershing Square Holdings, postponed plans to launch a US fund due to a lack of investor demand. This move had been expected to lead to a reduction in the performance fees paid by the UK-listed trust. Lastly, we said goodbye to Hypnosis Songs this week, as it was delisted following its takeover by Blackstone. This trust, of course, has been a regular feature on this podcast over the last 4 years, although not always for good reasons. There was no new fund profile at our subscription service, the Moneymaker Circle, this week. However, next week there will be a profile of Oryx International Growth, the UK small cap trust that's run by Christopher Mills. Finally, before I hand over to Jonathan for his interview with Denis Jackson and Laura Foll, there will be no Moneymakers podcast next week.
So I had the chance this week to talk to Denis Jackson and Laura Foll to talk about the Law Debenture Corporation, which is a very interesting vehicle that sits in the UK equity income sector, but is unique in the sense that it combines a professional services business with an investment portfolio. Denis, I'm going to start with you. You've just produced your latest interim results. That unique structure has proved very successful over the last 5 years at least. You are the best performing trust in the UK equity income sector. Perhaps you could just remind listeners of how the two parts of the business work together.
Of course, yes. And thank you for your kind words, Jonathan. And thanks for the opportunity today. So you're right. What makes us unique is we've got two distinct but complementary parts. The piece that Laura and James manage is our investment portfolio, which on the results that we've just announced is 80% of our net asset value. And then the other part of the business is the professional services business, which is about 20% of our net asset value. But crucially, over the course of the past 10 years, that's covered about a third of the dividend. If we can consistently grow our cash profits in our professional services business, we believe, and history tells us, that gives Laura and James increased flexibility in portfolio construction, which produces material outperformance versus the benchmark over time. So the key to the success of our unique model is driving cash growth within the professional services business. I would say, however, it's two-way. It's not a one-way street. It's very helpful to the whole. But what's really helpful to the professional services business is when we're competing for business, we're part of a 135-year-old, £1.2 billion FTSE 250 listed business with all the governance that goes with that. That's really key because a lot of our competitors could be privately owned or relatively modestly sized businesses. So it's a real competitive advantage to have that capital base, track record, and governance support when competing for long-term business, as we do within the professional services businesses.
Well, before we go and look at that a bit more, perhaps we could just add a comment there, Laura, from your perspective about what Denis has been talking about the added flexibility and freedom that he says you have to manage your equity portfolio. Obviously, you and James Henderson manage a number of other investment trusts, such as Lowland and Henderson Opportunities.
Sure. I think the advantages of the structure come through very clearly if you look at, say, the top 5 stock contributors over a decent period of time. So say 5 years. The top stock contributors include the likes of Ceres Power, which is a hydrogen fuel cell company, the likes of Rolls-Royce. Neither of those companies currently pay a dividend. Ceres won't for the foreseeable future. They shouldn't, they're an early stage company. Rolls-Royce might pay a dividend actually pretty soon. They've got results, I believe, tomorrow. They will probably come on the dividend list again imminently, but it would have been very difficult to hold Rolls-Royce in any size within a traditional UK income fund structure where you're trying to meet the UK benchmark, so UK FTSE All-Share Dividend Yield, which is still around 4%, so a pretty high hurdle rate. The real advantage of this structure is that we have the freedom to hold those types of companies, so the Ceres and the Rolls-Royce that I mentioned, in size for long periods of time. And the portfolio itself runs at a dividend yield discount to the market for that reason. And we can just see that come through almost year in, year out in terms of the stock attribution, that it often tends to be those lower or zero yielding shares that are among the best contributors.
So I guess one question is, if it's worked so well for you in this particular space, why aren't others doing it? But I guess you'd say that's a function of history and the fact that investors don't normally like businesses that are two different streams, as it were, if they can value them separately. But you've been going a long time, Denis, as you said. Your professional service business has been going since the 19th century, I think, isn't it, originally?
That's right. Coming up for our 135th anniversary on the 16th of December this year. I don't know the answer to the question as to why other people don't do it. I suspect if Laura and I were to approach a VC company today and say, we want to launch this business, it's going to be 20% professional services, 80% an investment portfolio, we would be looked at like we had collectively three heads between the two of us. And they'd say, no, you'd either be one thing or the other. You're right. This has evolved over history. Our owners like it. And our job basically is to not mess that up and continue to grow the capital within the business over time and produce steadily increasing income.
So in terms of how you've been able to do that, I mean, obviously there was a period back a few years ago when the trust traded at a discount and the professional services business was perhaps not doing as well as it is now. You've come in and you've introduced a new discipline anyway to the approach. What's been the key to actually generating that extra or continued growth in the cash flow of the professional services business that enables you to fund that dividend in the way you've described?
So I think the main change that we've made in the last 7 years is by investing in our business. So you're right. If you look at the period from 2011 to 2017, broadly through that period, with some wobbles through it, but the revenue was broadly flat, the expenses were broadly flat, and the profits were broadly flat. So in real terms, that was deflating. And I often think when I look at a business, if I look at the expense line that's flat, on the one hand, maybe analysts can look at that and get very excited and they say, oh, great, cost discipline. On the other hand, viewed through a different lens, you could be thinking, are you investing for future growth in the business? And I think that the wonderful portfolio of businesses that I was lucky enough to have inherited that have been developed over 35 years, they had tremendous people working in them who were excellent at what they did, who produced great output for their clients at excellent margins. As you rightly point out, the only group of unhappy, not I would say unhappy, but maybe slightly disappointed stakeholders at that point were the shareholders. So we had to get growth. And I think what we did is we challenged the businesses to think about what investments they needed in order to grow that business. And we didn't go on an accelerated J-curve, massive multi-million. We did it almost by stealth, invest a little bit, try a few things. If we get them wrong, move back. And if they start to work well, invest more. And I think the first example I'd give of that, maybe not the best, but certainly a very good one, would be in our pensions business. We were a pension trustee for, I think we're in our 54th year now. And as a pension trustee, we're effectively the non-exec director of a pension fund. But what we decided to do about 7 years ago was say, well, actually, there are administrative services we can provide around that. We can organize the meetings, we can take the minutes, we can do follow-up items. If there are beauty parades that need to happen, there might be projects that need to be done around GMP equalization. So we felt there were other things to do. So we hired our first employee. Today, we've got over 30 people in that business, and it's a multi-million pounds a year business for us. But again, it's just a question of listening to what the customers were saying and making the correct investments very gradually over time in order to support the demand that we were seeing.
So I guess one question is whether or not both sides of the business will be affected in the same way. In other words, how pro-cyclical they are, because most of your business is UK-based and you're investing in UK equities. So you would think if there was, for example, an economic slowdown, that's going to potentially impact both sides of the business at the same time. How do you deal with that particular issue?
Well, I think the last 5 years, obviously, it's just a convenient period to look at because 2019 to 2024 has been quite interesting economically. We've gone from 0 interest rates to sort of 5% interest rates. We've gone from no inflation to RPI of 14, now all the way back down to 2. We've had changes in government. We've had serious conflicts. We've had a pandemic. So there's no question that economically we've been through quite a bit. Again, I didn't inherit this wonderful portfolio of businesses, and they are a portfolio and they have nice elements of counter-cyclicality. One of our businesses, which is our least repeat, which is most exposed, if you will, to capital markets activity and economic activity, sits within our corporate services business. That's Service to Process. And we've seen in 2008 that tails off very quickly as capital markets activity dies off and economic activity slows. But we've also seen, as we recovered from the global financial crisis, we're able to catch our fair share of that business in our nets as more capital markets activity and economic activity assumed. We saw the same thing going into COVID, tailed off very quickly, and as it recovered, again, it's done well. So there are some businesses like that, which that would be our most exposed business. Equally, there are some businesses which can be quite counter-cyclical. So, for example, within our corporate trust business, where we act as a bridge between the issuer and bondholders, if you go back to the global financial crisis, 2009, 10, 11 were very strong years because when a bond goes into default or restructuring, we effectively become a law firm with the third best creditor position behind HMRC and the liquidator. We only need to do work, in fact, if we're indemnified or secured to our satisfaction. And there was an awful lot of restructurings and defaults to work their way through. So actually, if you analyze the company's results then, our main driver was that counter-cyclical business. So again, economic forecasts are always proven wrong, but if things go really badly, that's a very counter-cyclical business. The last thing I would say, we also have businesses that sit in the middle. Pensions need to be governed through all of that cycle. And the way that we get paid for those pensions is through the scheme, in almost all cases. So we need to be demonstrating value for money, but the demand side of that doesn't really change. There can be individual years that changes in government or the gilts crisis of autumn of 2022, which create extra work. But with respect to an economic cycle, it shouldn't really have a particular effect on our ability to grow our earnings in that business. So that's quite a long answer to your question, Jonathan.
It is, thank you. But nonetheless, very interesting. You've done extremely well, as you said. Over the last 5 years, you've produced a total return of around 12% per annum, when inflation's been about 4.5%, just a little bit over. So that's very good. That's beaten all the equity income competitors, as I've said, and is a very healthy real return. So I guess the question is, can you keep this up? I'll start with you, Laura. You, I'm sure, will be of the view that there's a lot of potential in the UK equity market at the moment for reasons we've discussed before, but are we actually going to see that now materialise, do you think, given how cheap the market is?
I think that's exactly the right question. If you look at, say, the half-year numbers, and I realise we're talking about 6 months, it's not a long performance period, but the recovery that we've seen so far, so the NAV is up 9% and a bit over the 6 months to the end of June, that's been driven by the large cap end of the market. So the results were driven by the bank holdings, the likes of Rolls-Royce, the likes of M&S, which are now in the FTSE 100. It wasn't driven by the more domestic, smaller businesses, the FTSE 250 and below. And it's really those smaller domestic businesses where the sentiment has been weakest since Brexit. The valuation discount has been biggest. So the performance has been good and we're pleased with it. But in a way, we haven't seen what we think is the catch-up of those domestic smaller companies yet. You can see it also in the rating of the portfolio. The portfolio is on about 11 times, just under 11 times forward earnings. That's as at the end of June, so that's capturing that recent NAV rise as well. And it just shows that these smaller companies are not quite capturing the imagination yet. Now, that might be changing in July. And I realise we're really talking short-term figures now, but the FTSE 250 is up over 6% in July. That's a very meaningful number for 1 month. So it might be that after the election, people are changing and looking down the market cap scale at some of those more domestic businesses. The reason I'm talking in this way to your question about 5-year numbers is there's always got to be the next baton within the portfolio, if you like, to move on. As in, Rolls-Royce has done what it's done and M&S has done what it's done over the last 5 years. You know, the likes of Ceres Power has been very helpful. in all likelihood, it will be a different group of companies within the portfolio that drives the next leg of growth. So in terms of how do we keep it going, you have to always be thinking, okay, well, how can we refresh the portfolio? What's coming next? And if we were to say what's coming next, if I were to have a guess, and obviously we can never make future performance guesses, estimates, whatever, but where do I think looks the most interesting in the UK market at the moment? I think it is those domestic smaller companies. And we have been gradually moving this portfolio towards those over actually quite a long period of time, so several years. If you looked at our weighting within the portfolio to domestic UK, because you've always got to be careful about talking about UK equities or domestic UK. They're not the same thing. UK equities are actually very international. We have been moving this portfolio to the smaller cap, more domestic businesses, and we now have almost 40% of portfolio sales here in the UK, and the benchmark would be more like 25. So we're actually quite overweight domestic UK for Law Debenture in a way that we wouldn't have been historically. And I'm hoping that that could drive the next leg that you asked about.
Do you agree with those who say that a change of government doesn't necessarily change anything? In other words, we've seen the election of a Labour government, which are going to do a number of things. They've said public finances are in a bit of a state. Do you see any positives or negatives that come out of that particular election result?
The way I see it is that effectively you could see Brexit as putting a higher risk premium on UK equities, particularly domestic UK equities, that has persisted very consistently over the last 8 years or so. We are now talking about an 8-year period. And I suppose the way I see the new government is no particular policy or political view, but does that risk premium on the UK still deserve to be there? And I look at continental Europe and I look at the States, and maybe I'm just a UK fund manager talking my own book, but I don't think that higher risk premium on the UK still deserves to be there. You're starting to see sterling respond to it. Sterling has actually been quite a bit stronger in recent months and since the election. So I see it more through that lens rather than through necessarily any particular policy announcements, of which there hasn't been much. Things like building materials shares have benefited from this idea that there will be more house building. We'll have to wait and see. We do have a decent amount of building materials exposure in this fund. We had it pre the election as well, but those shares are responding positively. So I think policy announcements at the moment are relatively muted, but it's more for me about the overall sentiment and, as I said, that risk premium being put on the UK.
And if I could ask your perspective on that, Dennis, one thing that we know is going to be in the spotlight is pension funds, where they invest, how they invest, whatever the plans turn out to be in detail. Is that potentially a positive for you, or is it a negative for you?
Yeah, look, I've written about this in the past in annual reports. Generally, it doesn't matter whether it's the red team, the blue team, the yellow team, the green team. If you get a change of government, a change of chancellor, they find this pot of money irresistible in terms of their ability to want to have their impact on it and change it. Our role, whatever the law of the land becomes around it, and so the great news is, King's Speech, there's a Pensions Act mentioned in there, which is dull to many, but very exciting to us because it's a new Pensions Act. So I'm not commenting on the effectiveness of any of the policies. I'm just saying that the reality is new rules will be put in place and they will have to be rolled out. And our job is to roll that out. So the bit that we weren't expecting at the start of the year, if you believe the predictions at the start of the year, it was that there would be an election in December, and the opinion polls at the time were pointing to a change of government in December. That's happened in mid-year. So the reality is all of that gets extended. As to what that looks like for pensions, we'll see. But one of the things that's being discussed in pensions is extending the period of supervision of trustees into retirement, because currently at retirement, people have to make all sorts of decisions about annuities and so on at that point. And one of the proposals, it's just a proposal, this isn't law, is potentially extending that oversight period for the trustees into retirement. So we'll see. As to, I think, what was thrust a part of your question was mandating certain investments in certain asset classes. Again, my personal view would be, I think frameworks are good things, mandated allocations less effective. But again, the Pensions Act hasn't come in, so we don't know what that looks like. But if there are frameworks that are created through different tax incentives or accounting changes that can encourage different outcomes, then hopefully if they're well put together, they can lead to meaningful improvements in outcomes for pensioners.
There's a couple of issues in that. I was thinking particularly perhaps of if there's a lot of consolidation in the DC business, or do you see that happening, and would that have an impact on you because you're acting as a trustee for them? Would that reduce your potential income in that area?
Yeah, I think that ship sailed for some time. The good news is the pension regulator, for many years now has been looking for a smaller number of better governed schemes. The reality is there are many thousands of schemes in the UK and we deal with several hundred. So as that consolidation happens, the reality is we've got the ability to actually cover more funds of meaningful size. And also another area which has been mentioned in government discussions is consolidating lots of local government schemes, of which I think there are 86. We don't actually serve any of the 86 schemes right now. So if they split into 8 or 1 super fund, those 8 or 1 super fund, I would suspect will have a very high governance bar put upon them. And that probably increases the chances that we could get put into a role. So at worst, I would say it's a neutral for us, but at best, there's a smaller number of schemes that need to have improved oversight. The regulator is looking for the increasing professionalizations of trustees, so that sounds like opportunity to me.
I presume from your point of view, Laura, if there was mandated pension fund investment in the UK equity market, more of it anyway, and any other reforms that the government can come with, that would presumably be helpful to you, because anything that drives up demand for UK equity would be positive for you, presumably.
That would definitely be helpful. I think the way we see it is that Brexit showed the fragility of the UK equity market to overseas sentiment. We lack, or somewhat lack, that very long-term institutional investor base in the UK. So a return of that, even if it was relatively small scale, would make a meaningful difference to the UK equity market and the valuations of the equity market. So yes, we would definitely support that, but we don't pretend to know what the right policy outcome is. There are other people in the room that would know that more than me and James.
I see. In terms of the trust itself, it has recently come back to trade around par, which compares, very favourably with a lot of the other trusts, both in your sector and more generally across the investment trust sector. It's pretty rare to be trading around par, even at a premium. Can you take advantage of that? Or do you intend to take advantage of that? And if so, how would you think about doing that?
So I think over the course of the last 3 years, we've been opportunistically issuing when our shares are trading at a premium of greater than 2% of net asset value. And post the results, it's Wednesday today, we issued some shares on Monday and Tuesday of this week because we were trading at just over that 2% premium. So I think over the course of the last 3 years, we've now just gone through the £100 million mark in terms of equity raise. So we're quite content to continue to issue if there's demand to do so with a net asset value over 2%.
What's been the trend in your share register over, say, the last 5 years or so? A lot of investor trusts, particularly in UK equity income, are very keen to attract retail investors. But can you enlighten us a little bit about whether there's been significant change there?
Very similar trends to what we're seeing across investment trusts elsewhere, in that the retail platforms are an increasing portion of the register. So the likes of AJ Bell, for example, have moved up quite meaningfully on our register, which we find really encouraging. I think people understand this trust a lot better than they did historically. You asked a question a while ago about why the discount has come in. I think part of that is definitely to do with IPS growing, but I think part of it as well is that people understand the proposition more, and we're trying to be more transparent in how we're communicating. So I think it's really encouraging to see those retail investors come on board.
The other factor then is, what's your approach to gearing? What are you doing at the moment, and how do you see that developing over the next period?
So the gearing's stayed about flat in the last 6 months. It's roughly 12%, 12.5% as at the end of June. The gearing reflects the fact that we are positive about the UK market and we want to be invested into that. There have been times in the past that this trust has been net cash, but now is the time where we kind of want to have our foot on the pedal and make sure that if and when those UK smaller companies do start to do better, that we're fully invested in the area. So the gearing reflects how James and I are feeling about equities generally, but UK equities in particular at the moment.
And I think just to underscore Laura's point, in my relatively short in the history of the company, but in my 7 years as a director of the company, we've had gearing as low as just under 1%. And the highest we ever got was, I think, high teens, just at the maximum point just in March of 2020 around Brexit, where we're actually incrementally investing in the market at that time.
The other question, which perhaps follows on from my earlier one, is there's a lot of consolidation going on in the investment trust world. Do you see Law Debenture playing a part in that?
I think it's something that we're obviously keep an eye on, but we are a £1 billion trust. The story seems to be well received. The fact that we're able to issue shares, we think is confirmation that people like our model and it's working well. So the main argument for consolidation is critical mass, but we seem to have that. So as long as we remain that part of the conversation, then there's no reason for us to change that, I think. And that's a decision for the board of the company, but that's me speaking as a director of the board that's obviously had those conversations.
It all sounds like it's all going very swimmingly and the results are good and everything is fine at the moment. What are the main risks out there to how you see things developing?
So James has this expression that you never want all your flowers in the garden in bloom at the same time, because if that's the case, in 3 months' time, your garden will look dreadful. And I have to say, no matter how hard we try, we've never had all the flowers in bloom in our garden. So yes, we're pleased that, as we say, the portfolio business has done well. But look, if you look within our portfolio businesses, one where we need to see some growth coming through is our CSS, our company secretarial services. Highlighted that in the annual report. We bought this business 3 years ago. It was a non-core business for the vendor, which was Evershed Sutherland, and we've had to invest a lot of money in people, skills, training, technology, and infrastructure. At the time, we said it was a cost in acquisition. These things always take you a little bit longer and always cost a little bit more than what you thought, but we think there's definitely room to grow that business. So we would like to see that coming through. So that's not a flower that's in bloom. It's a flower that we want to have bloom. And I think that our pensions business, we think, is a great business, but clearly on the back of a tremendous year last year, it's just got a tougher comparator to deal with in the short term. If you just by way of reminder, that was up 23% of the half year last year. That was on the back of a whole load of work that came through at the end of 22 into 23 with the gilts crisis. Great business, but its comparators in the short term will look a little tougher.
And then from the portfolio side, in terms of what would keep me up at night, we haven't spoken too much about the UK economy, but I feel the UK economy is probably in a better place than people realise. But I have to say, I don't feel that way about the US economy. I think the US economy is showing signs of consumer weakness, of slowing down. Now, clearly rates, like in the UK, will probably be heading down sometime soon. But I think the question that I have in my mind is, are rates in the States going to come down quick enough to abate some of that slowdown? And the reason I worry a bit more about the US, by the way, US equities in Law Debenture are only 3.5% now. We've taken the US equity rate down a long way. Is that valuations in the US don't, in my mind, leave much margin for error. You know, you're talking about a US market that I was looking at the S&P yesterday morning is on 21, 22 times earnings. That's very, very different from where the UK is sitting. So whereas the UK, people complain about maybe it's going to be 0.8% GDP growth this year. Okay, fine. Well, it's not super stellar, but we're on an equity market that's on 11 times earnings. The US isn't in that position. I do worry about that, and I worry that if the US does slow down, you know, the saying about US sneezing and everyone else catching a cold, that's the kind of thing I worry about. But I think we just have to focus on companies. When I get that kind of worry, I go and meet one of our industrial companies and talk through with them, okay, what happens if tariffs come on? What happens if the US economy slows down? And I almost always leave company meetings feeling better about life and thinking, yes, I'm glad I just sort of sat on my hands and didn't do anything with those industrial companies. So that's what would worry me. And I suppose the other thing is just, we've got so used to this in recent years, but just external events that you would never have predicted 12 months ago. You know, we've had so much thrown at us in the last 5 years, pandemics, wars that we didn't expect, etc. You can never discount that kind of thing happening. So that would always be in the back of my mind as well. And the way you mitigate that is we have 150 holdings that are deliberately very diverse. This is not a thematic portfolio. You have to have holdings that you know will act very differently in different economic backdrops.
It also worries me enormously when sensible commentators like you say everything's going swimmingly, because if history tells me anything, whenever anybody says that to me, things start to go not swimmingly very soon. So it's expect the unexpected is a good rule of thumb. No room for complacency.
That certainly worries me, yeah. Final question, perhaps, Laura, if I could put this to you, both of you actually. As I said at the beginning, you manage a number of investment trusts, Henderson Opportunities and Lowland and this one. Presumably, the logic of that is that they can appeal to slightly different investor groups. Perhaps you could just remind us how you see those three, at least, what they do differently from each other and how do they fit into a perhaps an overall portfolio that an investor might have?
Sure. So the uniqueness of Law Debenture, which I think we've covered well, is the combination of the two. That would obviously be unique to Law Debenture. Lowland and Hot are traditional investment trust structures. There's no operating businesses within them. So if you were, say, a retail investor and you wanted an income that you felt very secure in, you know that you've got effectively a third of the income in the bag, if you want to call it that, with Law Debenture at the beginning of every year, and then the portfolio supplements that with the other 2/3 of the income. You've got an added degree of security there from that, as we talked about, very unusual historic structure. Henderson Opportunities Trust is a completely different proposition. It's 45% on AIM. It's got a lot of early stage growing UK businesses, some quite nascent businesses within that. I often think of it as almost a child ISA fund. If you want a holding for 20 years, you put it away. These are businesses that some of them we think could go on to be much larger companies. Some of them won't, but we think some of them have real potential. That's Hot. It has a secondary mandate to grow its income, but it's not an income fund. It's a capital growth fund. And then Lowland is a small and mid-cap focused income fund. It would be the most exposed to domestic UK. It would have more in small cap. It is a smaller trust than Law Debenture. And it would be, if you had an investor that thought the UK economy is doing better than people realise, there are good UK businesses out there that people are not paying attention to anymore, then Lowland would have those small and medium-sized domestic businesses. So the three of them are very different propositions. You've got two income funds in there and one very much capital growth fund for different types of investors looking for different things. I think that's absolutely fine. We need to make sure they're three distinct propositions, which I think they are.
So you get a higher yield from Lowland, but the dividend is growing more slowly, essentially, over time. At least that's been the pattern recently.
The way to think about Lowland is those small and medium-sized companies cut dividends during COVID to a much greater degree than larger companies did. They're smaller, more cyclical businesses. So Lowland is effectively, or has been, it is now covering its dividend again, but it has been for a period of years growing back into the dividend that it was paying. I'm really pleased to say it is now covering its dividend again, but it did grow back into it. And remember, just to touch on discounts, we touched on the fact that Law Debenture is at a small premium. Lowland's at about a 12% discount, which clearly inflates the dividend yield at the trust level, not at the portfolio level, but it makes the dividend yield seem higher.
And I guess I should end with one final little quirky thing, which is you're very proud of the fact that you've either maintained or increased your dividend for 45 years, but you're not one on the AIC's Dividend Hero list because one year you didn't increase it by 0.01 of a pence or something. Does that really make any difference, do you think, to how popular the trust is?
Oh, gosh. Look, I wasn't part of the organisation. It'd be unfair of me. I didn't have the information at the time, but it was potentially a very expensive £100,000 that we didn't spend because as a marketing piece, that would make a difference. I think it would make a difference. There's another fund in the Janice Henderson Staple City of London, which does make a big deal out of that. And it is a very hard-won record, and we don't have it. So, yes, I'm disappointed that we don't.
But you're working your way back towards it.
That's all we can do.
All you can do, indeed. So that was Denis Jackson and Laura Foll speaking on behalf of the Law Debenture Investment Trust, talking to me this week.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.